Let's talk monetary policy. From mayonnaise to monetary policy, Ghana's central bank lifted its key interest rate by more than expected, extending its steepest phase of monetary tightening to ensure inflation decelerates at a faster pace. Governor of the Bank of Ghana, Dr. Ernest Addison, Monday said the Monetary Policy Committee raised that key rate 150 basis points, 29.5. The MPC has now hiked by 16 basis points since November 2021 to stem an almost 50% slide in the CD against the dollar because of concerns about its ballooning debt load, fanning inflation, which at 52.8% is more than 5 times the 10% ceiling of its target range. Allison also said the inflation rate is projected to decline to 29% by year end. For more, we're joined by Fred Duvor, CEO, Apakan Securities. Fred, good evening to you, sir. Good to see you. Were you surprised by the Bank of Ghana's rate hike on Monday? What were your expectations?
Well, 100% it came as a big surprise, considering that from December last year to February this year, we have been on a disinflationary path, albeit marginally. More so in January, when inflationary risks were much higher, we saw the central bank only increase policy rate by 100 basis points. When you also look at the general major inflationary factors, which are usually the depreciation of the cedi, global commodity prices, all of these have at least a short-term positive outlook. So the cedi has been stable over the past 4 weeks. In fact, we have seen it gain a lot on the USD. So you couple this with the positive base effect that we're expecting. It was our expectation that the central bank was going to hold the rate, and even with an increase, we didn't expect it to be by 150 basis points. So I guess the BOG is taking no chances, and it really wants to anchor inflationary pressures.
Yeah, but is that working? I mean, if one is to ask you now what the central bank is looking to achieve with this massive increase to 29.5%, and they're saying they're trying to get inflation down, is that working?
Well, I believe that the objective of the bank is to turn the squeeze on liquidity in the economy with this hike. What is worth noting is that not only was the policy rate increased, the cash reserve ratio for banks was also increased from 12% to 14%, and this is on the back of a required reserve ratio increase at the last policy meeting to 15%. So it is clear that the central bank is being aggressive in attacking the demand factors or the demand side of inflation, and it is trying to sustain the disinflationary path that we have seen over the past 2 months. Maybe it's not too happy with how slow the inflation is declining, and wants to see a more steeper decline in the coming months.
All right. Well, your cash reserve ratio is 14%. Ours in Nigeria is well over 30%. So how does the latest Bank of Ghana rate hike, although play into what the Ministry of Finance is doing, Fred, in terms of increasing or trying to increase economic growth and balance the fiscal position for Ghana?
In my opinion, this move is actually counterproductive to economic growth. The rate hike will feed into the lending rate for banks, making cost of capital more expensive for businesses. In February, we saw that the S&P Global PMI revealed that business confidence in Ghana was at a 3-month low. Also a slowdown in consumer demand as a result of this will also slow down growth. So with an already lower growth projection compared to what we got in 2022, we were hoping that the central bank will be more balanced in its approach towards rate increases, especially since, like I mentioned earlier, the inflation causing factors all have a short-term positive outlook. Slowdown in growth, as we know, may have a corresponding impact on the government's tax receipts, which may have a negative impact on our fiscal position.
All right. How much progress is the government making in terms of debt restructuring, all the haircuts and so on and so forth? Looking like the Chinese are ready to make a deal. Can you update us on that?
Yeah, I mean, that's some positive news. We know that following the domestic debt exchange program that the government concluded in February, it has been looking to restructure 5.7 billion of its external debt. And as it stands, the news coming in is that the Paris Club, China, India, Saudi Arabia, Turkey, a few others have agreed to form an official creditor committee and provide us with the financing reassurances that will enable us put a positive case in front of the International Monetary Fund. Now, China holds about $1.7 billion of that debt, and it has pledged its commitment to help resolve Ghana's financial crisis. So these developments are quite positive in our bid to restructure our external debt. And if the discussions and negotiations go as expected, I think Ghana will be able to get an IMF board approval by the end of the second quarter at the latest.
All right, yeah, you mentioned China. That's why I guess Kamala Harris was scrambling over to Accra to announce that 100 million, aid over to Ghana and some other regional governments. First quarter 2023, market coming to an end. We already looked at the markets. They did close today in the red. Can you review the first quarter for us across the major asset classes over in Ghana?
Well, so starting off with the equity market, we began the year from where it left off in the last quarter of last year with a very weak performance. The composite index in the first 2 months of the year returned 3.24%, minus 3.24% actually. Generally, market sentiments have been weak. However, in the past few weeks, in the past 2 to 3 weeks in March, we see the index recouping losses it made in the first 2 months with a positive year-to-date return of 14.69%. Now, this rally that we've seen in March has been driven by 3 main counters. MTN, which has posted 47% thereabouts return year-to-date. Total Energies also has returned about 59%, and Benson Oil Palm Plantation returning about 39%. On the fixed income market, activity has been woefully slow, which is expected due to the domestic debt treatment that which was only concluded at the end of February. Now, the total volume traded for the first 2 months was 19 billion, which is about a 46% decline on what we experienced last year. Yields have also tanked following the repricing of government bonds. We see that Treasury bill rates have dropped from an average of 36% to currently an average of 22%. So, I mean, if you're in government quarters, all these are positive developments. And as cost of borrowing is going to be lower for government. One thing that is worth noting is interesting is that in the first quarter of this year, the government has, on the treasury market, raised an historic amount of about 36 billion cedis from treasury bills. This is about a 200% increase from what it did last year. And it is due to the fact that the government is literally locked out of all other financing quarters. It can't issue any new bonds. It can't go to the Eurobond market. It's still in talks with its bilateral lenders. So the treasury market has been the only source of funding avenue for the government. So we've seen quite a lot of activity in the treasury bill market.
Fred, I badly wanted to follow up with the real rate of return at inflation at 58% and then stocks doing 47, 37. But we're out of time. Fred Duvor, I'll catch you next time. CEO, African.
All right.
Thank you so much for joining us from Accra.